First, get your financial clean and consistent. Second, move personal expenses from business. Third, maybe it's good to start training a second layer of management other than you yourself. Succession. Or maybe not really succession, but someone who can run the business while you are handed to the new buyer. So at least there are some processes, there are some system is in place while you are not there, right? So the fourth one, if you can build recurring revenue, if possible, then go for it.
Welcome to the iSearch podcast. Today we have Roger Loh, who is a chartered accountant and certified valuation specialist. So in this episode, we'll talk about how to value your business and also prepare for a successful exit in 1 to 2 years' time. So welcome to the show, Roger.
Hi, Benjamin. Hi, thanks for having me. Just a little bit introduction about myself. I've been working in the business valuation space for the past 10 years across startups, family businesses, and mid-sized companies. Some are preparing for exit, some are raising funds, some just want to know what's the business worth and how to grow its value. So yeah, happy to be here, Ben.
All right, great. So let's start. So in your opinion, are all businesses sellable?
This is a very hot question I always receive from the business owner. The short answer is not all the businesses are sellable right now, but most can be made sellable with the right preparation. Right? Maybe let me give you an example. Right? A lot of company, a lot of business owner, they are doing sole proprietorship. Right? So meaning owner means business is owner. So there's no separate legal entity. Right? So the question now is, if I want to sell this business from legal structure perspective, how are you going to sell it? I mean, the business is the owner. You can't separate it. So that is one of the very very obvious example I can share with you. But if you ask me, can it be sellable? I would say yes. You need some kind of preparation, like 1 to 2 years, clean things up. Build some value. Maybe now your accounts a lot of expenses is your own personal expenses because it's your sole proprietorship, right? So maybe your own personal expenses also part of it. So you can't see the real profit, right? So just maybe need some time to clean the accounts and do something on that. Yeah. So eventually you still can sellable, I would say.
What if they are like businesses where it's like a service business? It's like there's like a lot of key man risk. Like for example, let's say a marketing agency, advertising agency, even some accounting firms, right? They are very dependent on the owner. So even though they have a Sandra Berhad and not so prop, but yeah, are these type of businesses like sellable, or what should they do to make it more sellable?
This is a very good question, because the next question is whether the customer relationship is attached to the business or attached to the owner. Let me give you an example of clinic. Sometimes we're not feeling well, we visit a clinic, right?
Yeah.
We always visit the same clinic, because of the doctor. One day I visit the clinic again and see, different doctor already. Somehow the previous doctor sold the business to this new doctor. Now next question is, do I still want to continue visiting this clinic or not? No. Yeah. Probably no. Because why? Because I don't have the personal attachment with this new doctor. Yeah. So normally, how it's structured, in this example again, the clinic deal, normally based on what I see, right, after they sell it, they will not exit completely. They will stay on for say like 6 months, 1 year, 2 years. So every time when there's new patient come in, they will say, okay, I'm still here. By the way, this is the new doctor or something like that. So at least you start to build some rapport with the new patient, so that next time when the patient come back, you'll feel a bit more comfortable dealing with the new doctor. So that depends on whether the business value is attached to an individual or attached to a business.
So how is business typically valued? Like what are the most commonly used methods in Malaysia?
So there are two kind of valuation approach that is very commonly used. One is market approach. The second one is income approach. Now, market approach is something I would say will be a bit more straightforward. Even the business owner can do it. Income approach, you may need some kind of projection, you may need some kind of forecast and all this, a lot of assumption. Maybe it's good to let someone with some accounting knowledge to do it. So maybe let me focus on the market approach, since that our audience is more on the entrepreneur and business owner, right? So one of the very common kind of market approach we use, we call it EBITDA multiples, right? So EBITDA multiples means earning before interest, tax, depreciation, amortization. Now, why we use this? Why we don't use other metrics? Like for example, if you invest in capital market or Bursa Malaysia, a lot of uncle auntie, they use those PE ratio, right? I mean price to earning ratio. Why we use this? Actually there's a story behind. In short, I would say that EBITDA is something like a proxy of operating cash flow. It's a proxy. It's not exactly, but it's like a proxy. Even accountants, they did not have cash flow statement until 1980s. But how about the M&A deal? I mean how the deals value the business, right? So they use something called EBITDA. So if you look at the formula, right, EBITDA, you minus, you take out the interest. So why we take out the interest? Because disregards of the capital structure. Even I fund 100% of equity, I have no interest, right? If I fund 99% of the of my business to using debt, then I have a lot of interest expenses, right? So I want to consistent it. I take out that. Tax I take out because it's a statutory obligation. Whether I do well or not well, I can't control it. So I take out that. Depreciation, amortization, these are non-cash. I mean, these are expenses in the income statement, but there is no real cash flow. So if I take out all these items, as I say, it's approximately I can get something like a operating cash flow. So therefore, EBITDA is something has been useful since day one. I mean, people are using EBITDA multiples to value business, I would say. But of course, EBITDA, I'm not saying that EBITDA is the best method. It's just a quick method for you to gauge what is the range of the valuation you are talking about.
Okay. So then the next question is going to be the follow-up one. Is how many times of EBITDA?
I would say this depends on your industry and so-called the business life cycle, right? Of course, if you're talking about growth stage versus a sunset stage, I mean, definitely it's a very different kind of multiples, right? I mean, you may have one industry talking about like 5 times, another one talking about 10 times. So I would say we need to find the peer comparables, like for example, your company versus your competitor. So that's make more sense to me rather than you're looking at a generalized as a whole.
Right. So how can business owners get this data? Let's say if they want to see like a peer-to-peer comparison, because like of course listed companies you can see lah, right? What's their acquisition, all those things. But then let's say I mean most of the audience is SME business owners, right? So yeah, how can they find this comparison?
I would say that depending on your comfort level, I mean, if you just want to have a very high level kind of range we are talking about, you can use a listed company. I mean, listed company that publish their earnings every quarter, right? And you can see the share price. So somehow you can work out on the multiples. I mean, that is the more high level way. But of course, that is not yet adjust some of the valuation adjustment. So if you want to be very precise, probably you may need to work with your advisor. But if you just want to have a very rough idea, you can just plug from the public information. That will do.
Okay, right. So what are some like common misconceptions or mistakes business owners make while they're like trying to value their business?
One very big mistake maybe I want to quote one example. Suddenly come into my mind is they always think that their business is based on X times of revenue without reference to the profit. That is a little bit no to me. I mean, it's not that I have a lot of revenue, then my value will be a lot, right? It depends on your profit as well. It depends on your cash flow as well, right? So I remember there's a saying they call revenue is vanity, profit is sanity, and cash is king. So as while revenue is a good benchmark to start with, we also need to look at what is your margin, right? Because different business model has different margin, different costing, and that's actually drive the valuation of the business, I would say, right? Maybe another one I also want to share. Sometimes I got this comment from a business owner. They thought the value is based on how hard they work or how much they need, right? They say, okay, I've done A, B, C, D, E. Okay, because of this, I need X amount, or because I done A, B, C, now I need to do D, E, F. Okay, because of this additional thing I need to use, right? The value is Y amount. I would say that it's not that simple. I mean, a buyer would not value in that manner. So yeah, that is what I trying to trying to share with everyone about the misconception.
Yeah, so besides revenue, you also have to look at like the bottom line, the profits, and also the cash flow and all.
Yeah, yeah.
Okay, right. So let's talk about like real life. So could you share some real life stories of business exits that you have done, and also like what makes them succeed or what makes them fail?
Maybe I can share a success story and one not that success story for comparison purposes.
Yeah, great.
Okay, so there's one logistic company or logistic business. They foresee they're going to sell in the next 2 years. I mean, the owner is going to retire soon. So what they do is for 2 years they clean up the books, right? And they did structure the text before. So for the last 2 years they clean up again, right? And they put back the profit back to the business where they should be putting, right? And they show some so-called stable recurring income, right? So it is an exercise because some SME that tend to do some so-called tax planning. So it's good to it's good before you do valuation. You already start this exercise to clean up all this issue again.
Yeah.
And ultimately they got 7 offer, right? So I call this as a success story. Now I also have another one, not too success story. This is one of the retail chain. The owner has a health issue, so they want to sell very last minute. No succession plan. Basically, there's no second layer of management to help them to run the business. Then you notice that they will have some staff turnover also. So actually, this scared the buyer, right? I mean, there was a buyer in the middle of due diligence look at this issue and they pull out and I think they failed to sell off the business eventually. So if you ask me what is the story I learned for these two story, right? I would say that the difference between these two story is planning. One plan well before they eventually sell it to potential buyer. Another one, they do it very last minute and everything is very chaos and ultimately they're not able to sell their business.
Then I'm curious on the story of the second story. So you say that the owner have health issues and he's probably a solo founder, right? And then the staff maybe that left and all. So what happened to the business in the end? Did he shut it down and just get nothing, or he just continue on?
The last I heard is the business is still on, but is they are reducing the size already.
So I think the lesson here is probably the first one is to have like succession planning in terms of people, and then the second one is to accounting wise to like really clean up the books to make sure it's clean, that kind of thing. Right. So what are some key financial metrics that matter most in a business valuation? Is it like EBITDA is the most key, or do buyers look at other things as well?
Yeah, you're right. I mean, EBITDA is definitely one of the key items because that's what the buyer is always looking for, right? So other than EBITDA, there are four more other things I want to share. So EBITDA first thing, so total five. So EBITDA, as you mentioned just now, and of course when you talk about EBITDA, you are talking about EBITDA margin, right? So how much margin you are talking about compared to your peers. So if for example your peers is talking about 20%, yours is 5%, something is wrong, right? Not to say automatically is something wrong. Maybe there's some very good reason why it's 5%, but that will be something like a question the buyer may be asking. On the other hand, sometimes it's too rosy, also problematic for you. Like for example, if your competitor is 20% margin and you are reporting 50% margin, that's raised an eyebrow also, right? I mean, how come you are? I mean, maybe you have a very good story about it, but why you able to have such a very huge difference compared to your peers? Is this sustainable? I mean, that will be some question, right? So yeah, EBITDA is one of what is the first one. The second one I want to share is the revenue trend, whether it's growing, whether it's flat, whether it's declining. Because why? The buyer is always looking at your company, right? Whether it's growing, then they'll make some forecast, right? After I buy over, whether it's continue growing or this is a declining kind of company. So this is very important for them. The third one is the customer concentration, right? So we're talking about revenue. Yes, it's growing, but is it rely too much on one customer? Or if, sometimes we do something called like top 10 customer analysis. How much revenue is contribute from this top 10 customer, right? If you say, okay, the revenue contribution is from top, especially the top one or two is like 70%. That is actually something will be a risk from buyer perspective also, right? The last one I would say that is working capital. So some businesses, they actually tie up too many cash in inventory, or sometimes they tie too many cash in a receivable, right? In the AR, there are so many customers owing them money. So this is something also will affecting the business value as well.
Okay. In terms of revenue, right? Like you say that the buyer wants to see like there's a trend of like up lah, like maybe every year up, I don't know, 5%, 20%, that kind of thing lah, or even more. Let's say, what if revenue trend is going up, but profit is going down because scaling phase is like, yeah, you need more employees, you need more cost, that kind of thing. Is that like a reasonable thing, or you think like both have to be in line? That means revenue go up, profit also must go up.
Okay, to answer your question, revenue go up is not the necessary buyer is looking for. Sometimes flat is okay. Like for example, I'm buying a mature company. From day one, the buyer knows that he is buying a mature company, so he may not expecting like 20% growth. I may expect like inflationary growth. That is good for them, right? So your second part of your question is whether do I need to find some kind of consistent trend between my top line and bottom line, right? So I would say that of course that is the expectation, right? I mean, you have higher revenue, you have higher profit, but sometimes it also reflecting the business model. Like for example, I have higher revenue because the competition is very fierce. Therefore, I actually drop my margin. I go for volume instead of value. So that is also the case. I mean, there's no one size fit all kind of advice what you should do. I mean, sometimes the business are in a situation whereby the competitor is very fierce, right? They are in a price war or something like that. they need to go for volume in order to survive. I mean, that is also possible. So that it's not an automatically red flag when you have this so-called different trend when you look at the accounts. As long as there is the proper reasons of why they have such a trend.
Yeah, lah. Need to like explain to the buyer like why is the numbers showing this way, lah. Then it makes sense, lah. Okay, so besides like financial metrics, what are the other factors that affect valuation? I mean, for example, like strategic fit or other things that is non-financial that affects valuation.
Actually, non-financial metrics are more like entity specific. But what I can do is I can share a general guidance. What are the typical non-financial factors or we can consider when we're looking at the valuation of a company? So first one I can think of is the revenue, recurring of revenue. So the quality of revenue is very important. Just now we mentioned about revenue, whether it's growing or it's flat or whatever, right?
Yep.
So the recurring is very important. Whether this business, majority of the revenue is project-based, for example. So if project-based means after the project end, then you don't foresee recurring revenue anymore, right? So the quality of revenue is very important. Or because my historical revenue is mainly make out of one-off sales. That is also something like points that I will be considering also. That is first. The second one I can think of is the owner dependence, right? So there are a lot of owner that do everything, right? So just like your previous question, what if the owner leave the business? Then what happens to the business value? So that's why if the owners runs everything, the risk is definitely higher from business point of view, because the value is attached to the owner rather than attached to the business. The third one is definitely the system or processes, I would say. So buyer, they will definitely more willing to buy a business with established system or processes, so that they don't have to build from scratch. So if, for example, if a buyer come in, everything is still very how to say not very messy, then they need to invest more time to rebuild the whole thing. That one will be another factors the buyer may be looking at. And of course, another one is a little bit related to valuation, but more on pricing, is the strategic fit. So sometimes you may have a very strategic fit kind of buyer, they fit you very, very well in terms of the business model, because maybe of the supply chain. So that will actually give you a bit more on, in terms of the pricing, not the value. Now, why I distinguish these two words is because to me, value is the same whether there's strategic client or there's no strategic buyer. But pricing is varies, right? If I have a strategic buyer, I may have a higher pricing. If I have a very friendly buyer, I may also have a higher pricing. So pricing is a bit more subjective, I would say.
Okay. So what are some like red flags that will scare off the potential buyers?
I think just now we covered few, right? The first one is poor or inconsistent financial records. That will definitely scare off the buyer. The second one is staff turnover. When the buyer come in and say, "Hey, why all the staff turnover is so high?" Or maybe there's no key employees. That is also another red flag. Another red flag I can think of is legal case. Especially as a defendant, when they perform a due diligence, they find, hey, how come you have so many legal case against this company? That is also another red flag they may consider. The fourth one is on the tax part. I mean, the tax audit. When IRB come in, they have some negative findings. This one also may have a issue when it comes to buyer, because when the buyer come in, basically they are inheriting whatever the tax issue that the seller is sharing with them. So that's why they will tend to be a bit more conservative if they see any tax non-compliance issue. The last one I can think of is very common: unrealistic price expectation. Sometimes when you're making like 1 million profit, they are asking for like 50 billion. So definitely this is something very very unrealistic. Yeah.
Okay. So like to prevent all of this, right? So should business owners work with like a valuation expert or advisor? And if so, like when is the right time to bring them in?
As a business valuation practitioner, my answer is definitely yes. But not to get a number, but more on understand what drives the number. I think that is very important. You bring your advisor or someone in 1 or 2 years before you plan to sell. Then that give some time for you to improve some weak areas. I mean, a good advisor, if you ask me, it will also help you to set some expectation, to avoid some tax issue, or even to structure the deal better. I mean, that's my 2 cents view.
Okay, fair enough. So about 1 to 2 years time to like really clean up a lot of things lah. Okay. All right. So finally, before we go, if a listener is thinking of selling their businesses in the next couple of years, what are some steps that they should do now?
Maybe this is a very good recap of what we have gone through so far. Okay, of course, first, get your financial clean and consistent. Second, move personal expenses from business. Third, maybe it's good to start training a second layer of management other than you yourself. Succession. Or maybe not really succession, but someone who can run the business while you are handed to the new buyer. So at least there are some processes, there are some system is in place while you are not there, right? So the fourth one, if you can build recurring revenue, if possible, then go for it. Then the last one, think like a buyer and ask yourself, would you buy your own business? I mean, that is my like last piece of advice to all the business owner.
Would you buy your own business, and how much would you pay for your own business?
Yeah, something like that.
Okay, great. So thanks, Roger, for coming onto the show. Check out his website down below, and I'll see you guys in the next episode.